Welcome to Thoughts on the Market. I am Vishy Tirupathur, Morgan Stanley's Chief Fixed Income Strategist. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the outlook for corporate credit markets. It's Wednesday, June 28th at 11 a.m. in New York. Our economists are calling for one more 25 basis point rate hike in the upcoming Fed meeting in July and pause thereafter until the end of first quarter of next year. They're also calling for continued growth slowdown because of the policy tightening that we have seen over the last 15 months or so. A restrictive pause, which means rates staying higher for longer, and muted growth will weigh more on the performance of the corporate credit markets, especially as refinancing needs pick up. So our call is for wider spreads, further decompression, and muted excess returns for corporate credit markets. Within credit, we favor higher quality, which means investment-grade credit over leveraged credit, both in bonds and in loans. Let's dig into some details. Investment-grade credit looks attractive from a duration lens, and we expect 7% plus total returns over the next 12 months. From a spread perspective, our base case target at 150 basis points calls for modest widening, although risks are skewed to the downside in the recession bear case scenario to 200 basis points. We think the banking space looks cheap versus the market, especially money center banks. We favor single A's over triple B's and shortening of portfolio duration. Our preference is to own the front end of the curve within the investment grade space. Higher for longer puts more pressure on lower quality borrowers. While the macro outlook is not acutely challenging for credit, it progressively erodes debt affordability. For larger and higher quality borrowers, we expect the net impact to be gradual decline in interest coverage ratios and a voluntary focus on right-sizing balance sheets. For smaller and lower quality companies, this adjustment could well be disruptive as 2025 maturity walls come into view. So even in leveraged credit, we would look to stay up in quality. The layering of leverage and rate sensitivity in loans informs our preference for bonds in general relative to loans. We expect loan-only structures to underperform mixed capital structures. We also expect sponsor commitment will be put to test. That said, higher quality names within the loan market are a way to benefit from the shape of the rates curve and generate better near-term carry. In all, we forecast wider spreads and higher default rates in the lower quality segments of the credit markets. Relative to the modest widening in the investment grade space, within high yield and leverage loans, we expect more significant widening in the range of 120 basis points of widening. This will result in marginally negative excess return for these segments and will screen even worse when adjusted for volatility and downside risk. We forecast default rates pushing above long-run averages with loan defaults outpacing bond defaults, especially after accounting for distressed exchanges. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.